Hi there, welcome back to the channel. Today, we are diving into a topic that might hit a nerve for many of us. How your car could be killing you financially. We all love that new car smell, but if you know the true cost of owning that brand new car, you may want to settle for the new car scent air freshener. So buckle up, hit that like button, and let's get started. The idea of hitting the open road and the sense of adventure associated with cars is deeply ingrained in American culture. We see cars as symbols of status and freedom. But sadly, cars are more likely to take away our freedom and security because cars are personal assets that lose value and drain our bank account. Let's look at a Toyota Camry, which is ranked the best-selling sedan in America in 2023. The MSRP for this 2024 base model Camry is $32,720, including taxes and fees. To finance for 48 months at 6.75% interest, you would have to pay roughly $780 per month. But it doesn't stop there. When you take into account of ongoing cost of fuel, insurance, maintenance, and depreciation, the true cost of owning this car can be as high as $1,015 a month. And that takes a huge bite out of a paycheck for the average American. According to ZipRecruiter, the median American monthly income is $4,880. This means 20% of your income will go towards owning and the upkeep of your car, making it really hard to save money and build wealth. No wonder 62% of Americans are living paycheck to paycheck. So why is it so expensive? The cost to finance a vehicle traps most people in a cycle of debt. Most of us don't have $32,000 in cash to buy a car. And what most people do is to put down a small down payment, around $2,000 to $5,000, and finance the rest with interest and fees. The interest on your car loan depends on your credit score. It can range from 5.65% if you have good credit to as high as 21% for those with bad credit. Paying too much on interest is like bleeding money. Be sure to shop around for a good rate and get pre-approved for a car loan at your local credit union or banks before you visit the car dealership. Remember, ask about all the fees associated with the loan so you're not surprised by the hidden charges. Bring this pre-approved quote to negotiate with the dealership. See if they can match or do better. If not, you already have a good option in hand. And don't fall prey to the shady financing tactics that dealerships try to sell you. Long-term financing may seem like a good deal because the monthly payments are lower compared to a shorter-term loan. But in the long run, you end up paying significantly more in interest. Let's go back to the Camry earlier. The 48-month financing at 6.75% with the monthly payment of roughly $780, the total cost to purchase this car is $37,440 over the life of the loan. That is more than $4,720 in interest and fees. Longer-term car loans typically have higher interest rate. The 72 months financing at 7.75% would give you a lower monthly payment of roughly $570. Don't be fooled by the lower payment because your total cost for the car is $41,040. That's an insane $8,320 in interest and fees. When you stretch out monthly payments, you also put yourself at risk of being underwater on your car loan, owing more money than what the car is worth. It's recommended for new cars, don't go longer than 60 months, and for used cars, no more than 36 months. You also need to factor in depreciation. Unlike investing in a house that appreciates in value over time, cars do the exact opposite. A brand new car loses about 9% of its value the moment you drive off that lot. That means the $32,000 Camry instantly becomes $29,120 as you wave goodbye to the dealership in your new car. Within the first year, many cars will lose up to 20% of their value. After that, they may lose about 15% more per year until the 4th to 5th year mark. Depreciation works on a curve, and new cars depreciate the fastest in the first couple of years. This rapid depreciation destroys value. To reduce the cost of depreciation, look for used cars at least 2 years old, ideally between 3 and 4 years old, around 30,000 miles. And that is the sweet spot where the car already went through most of its depreciation and still have a lot of life and good use left. If you can, look for a certified pre-owned vehicle, which comes with a detailed inspection and is backed with some warranty against defects. Then there's the skyrocketing insurance cost. I just paid for my car insurance and the premium went up 18% from just 6 months ago. Driving a car today is more expensive than it was a couple of years ago. The national average cost for car insurance is now $2,150 per year. You also need to budget in fuel cost as part of car ownership. An average American spends between $150 to $200 on gas every month. Expect to pay even more if you live on the West Coast. To keep your car running smoothly, you also need to budget for maintenance and repairs. According to AAA, a new car's routine maintenance and repair could cost an average of 9.83 cents per mile. Assuming you drive 15,000 miles in a year, that adds up to $1,475 annually. As your car gets older, maintenance cost will likely increase. You also need to pay registration fee and taxes, which can vary significantly between states. Oregon has the highest registration fees, between $268 and $636 for new vehicles. All these costs relating to owning a car add up to a significant amount of money. If we can focus on cutting costs in this category, it makes a huge difference in wealth building. The way to save money in this category is first to understand the true cost of car ownership. Realize how your car is burning a hole in your wallet. And to save money on car payment, consider buying a smaller and more reliable car. Don't buy a car to impress others. And each person needs only one car to get around. Don't get sucked into buying multiple cars. Reducing the number of cars you own can free up a lot of money each month. Also, get yourself off the hamster wheel of revolving car payments. Some people trade in their cars every few years for a newer or a better car. A lifetime of car payment is one of the worst financial patterns and wealth killer. Stop that cycle and keep driving the car you already own. And put those car payments toward building wealth to create a better future for you and your family. Let's say instead of paying the dealership $780 a month, you pay that money to yourself and invest that money in the S&P 500 index fund, which has an average historical return of 8% annually. If you're diligent about paying yourself every month for 5 years, you will have almost $57,000 thanks to compound interest. And if you continue to do this for the next 20 years, the money will grow to $446,000. And personally, I'd rather have close to $500,000 in my investment account than to have a new car every few years. We need cars to get around, and I certainly can't live without one. The problem comes when the car is purchased emotionally, and your car ends up owning you. So be mindful of your car choices and avoid the temptation to overspend. Buy only affordable transportation and invest the money you would have spent on a monthly car payment to secure your financial future. Thank you for watching. I hope you find this video helpful, and I will see you in the next one.